Good evening, I'm Sneha Koshi and welcome to Let's Talk Business. Bulls were in charge on Dalal Street today as both Sensex and Nifty scaled new heights. Sensex and Nifty 50 ended at record closing highs. Nifty crossed 19,000 level and Sensex breached the 64,000 mark. While pharma and metal sectors advanced, media stocks were under pressure. Hiral Dadia with the wrap of the market action.
A milestone day for the markets with the Nifty scaling record high levels. In fact, we crossed the 19,000 mark in today's session, as well as the Sensex crossed the 64,000 level. Overall, this has been the second consecutive session of gains. Now, what is to be seen from here on is how sustainable on closing basis do we manage to surpass the 19,000 mark from here on. A 500 points gain coming in on the Sensex. And if you see in terms of sectors, majority of them advanced in trade, but the highlight was the pharma as well as the metal pack. In fact, interesting news coming in terms of the metal sector as well. Reliance Industries also led the gains in today's session, and it was Bank Nifty which though underperformed the benchmark indices but ended in the positive. The mid-cap index saw gains of around 0.7%, whereas the small-cap index absolutely ended flat. So the momentum that we were seeing in terms of the broader markets has now been cooling off, and the action is coming back to the large-cap space. Overall, HDFC Life and Kotak Mahindra are few of the counters which dragged the markets as well. In terms of top gainers, you had Adani Enterprises, Adani Ports, JSW Steel, Bajaj Auto as well as the Sun Pharma, whereas on the losing end you had names like a Tech Mahindra, M&M, Apollo Hospital as well as a Hero Moto. If you look at the newsmakers, HDFC Life saw a block deal and it was a 7.77% equity exchange stance. BEML was in action today on the back of an order win. You have Adani group of companies which were up in a trade because of GQG as well as IHC and other investors who've bought nearly $1 billion. Titagar Wagons was up in trade on the back of an order win, as well as a TC NS Clothing jumped on the back of the CCI approval on the acquisition by Aditya Birla. So a lot of newsmakers in trade today, but a key milestone that we crossed in today's session, specifically on Nifty 50 at 19,000 levels. Back to you.
With markets hitting record high, we spoke to Ashwini Agarwal of Demeter Advisors about India's standing among the emerging markets. Listen in.
If you look back over the last decade or so, okay, the areas where you saw the massive multiple re-rating in the Indian context, and dare I say even in the global context, was FMCG, fast-moving consumer goods or consumer staples names. And several of these are very well-established, reasonable growth, but nothing spectacular type of businesses, right? With significant brand value and et cetera, as the drivers of value. But if you look at earnings growth is pedestrian, say 10-15% or somewhere in that ballpark. And you saw the valuations of these stocks go from 30x to 50x in the Indian context. So what happened? Why did that happen? Because these companies were giving you steady growth in an environment where growth wasn't there. Okay. So I spoke about the lost decade. The lost decade applied to the banks, lost decade applied to the entire manufacturing sector and so on. And within that, there was a small microcosm of companies that were growing. Think about it as India versus rest of the world. Okay. India is one of the few countries that's growing in a world which is struggling to grow. And that to me is the real story here. And if I just put my thinking cap on and see what happened to FMCG stocks in a zero growth environment or low growth environment, at a country level, the same thing applies. So I think looking at valuations or premium to valuations is a bit of a wrong thing, number one. Number two, in the EM context, India's premium has expanded because China, for one, the markets have corrected after the first Q1 rally, and that has brought valuations down to significantly below their median levels, their long-term median levels.
GQG partners, IHC Group and other investors have brought stake worth over 7,300 crore rupees in Adani Enterprises and Adani Green Energy. This is the third time that GQG partners have invested in Adani Group stocks over the last few months. Neeraj Shah is here with the details.
Well, there were large block deals this morning on Adani Enterprises, Adani Green. Shares to the tune of nearly $1 billion changed hands. And guess what? There's GQG partners yet again, coupled with IHC and some others putting in that money. And they bought the stake from the promoter family, which is the Adani family. Now, the interesting piece is, after putting in the initial investment back in March, they've followed it up with some more investing, about $400-500 million worth between March and May. And now that's another $1 billion. I mean, there will be some, because IHC also put in other investors also there, but let's assume half of it is also, if it's GQG, that's nearly $3 billion worth of stake that GQG has now put it into the Adani Group. Shows the confidence of a very large global investor with some reputation, putting in some serious money to work in assets which some people who believe in the strategy of GQG say that are undervalued relative to multiple parameters that they can point towards. And I would reckon that's probably one reason why Rajiv Jain and team are doing this. In fact, he was on record in the interview that he did with us last month, talking about how he believes that people are not valuing infrastructure assets correctly. And at some point of time, that valuation re-rating will help him create some serious wealth on the large investment that he's done. So, well, that was the news story on a day when the Nifties hit a record high, but that was the news story with regards to the Adani Group in today's session. Back to you.
And Neeraj Shah spoke to Devin Choksi about the infra space in India post the mega block deal. Listen in.
My understanding on the subject is that infrastructure assets which an investor is wanting to buy into the portfolio, there are two preconditions to that. If these infrastructure assets are in making or they are already made. If these infrastructure assets are already made and constructed or going on live, that means his time to market is basically covered up as far as an investor is concerned. Second thing, the price at which I think these infrastructure assets have been constructed. Suppose if my current price is X and if I have constructed these assets at X minus price, and I'm getting an advantage due to the market price of the stock to buy these assets at the current market price. In my viewpoint, I think I would probably take the view that, okay, next 25-50 years, if I have to be invested in, if infrastructure assets are already operationalized and generating revenue out of it, might as well buy at the current market price, because I think in future these prices are likely to go up. That is where I think I'm more comfortable out. And that's where I believe that I think the requirement for buying into India infrastructure story has started gaining momentum. Till the point of time, I think the Adani group of stocks, I think, were commanding higher amount of valuation. The question was on high valuation. Today, the question is on how much below it can go down to, given the strength of the assets. And that is another reason for which I think the transaction for buying into these assets. And the third important reason, which according to me, I think would be that every global investor is looking at India very favorably. After, I think, successful marketing of India and India infrastructure story, I believe that every global investor wants to buy into. So the one who has basically taken an early entry, he clearly has an advantage. And the current market price possibly makes that condition possible to buy and take an early entry.
In an exclusive interview with BQ Prime's Vishwanath Nair, HDFC Limited Keki Mistry talks about the legacy of the mortgage lender and the upcoming merger with HDFC Bank.
Mr. Mistry, I want to talk to you a little bit about these two large organizations that are merging together, right? HDFC Bank and HDFC Limited. One is a multi-decade old housing finance company. The other is also a multi-decade old bank. What is the scale of this merger that we're talking about?
The scale will be massive. The scale will be huge. Whether it's in terms of total assets, whether it's in terms of total deposits, whether it's in terms of the market capitalization, will be huge, enormous. And then the subsidiaries, which is HDFC Life, HDFC Asset Management, HDFC General Insurance, the HDFC Capital Advisors, all of that will fall as subsidiaries of HDFC Bank. So enormous scale, huge potential in terms of cross-selling, massive potential in terms of cross-selling, because today the bank has something like 8 crore plus customers.
Yeah.
And only 2% of them have taken housing loans from HDFC.
Oh, okay.
5% have taken loans from other banks. and roughly 93% have not taken a loan at all. So look at the ability to cross-sell to the 93% who have not taken a loan at all, and to the 5% who have taken loans from other entities. Similarly, at HDFC Limited and all our subsidiaries, the number of people having banking accounts or banking relationship or primary banking relations with HDFC Bank is far lower than where it could be. So there is a massive cross-sell opportunity.
What do you say as a piece of advice to whoever is going to manage now this housing finance portfolio going ahead within the bank?
Advice is that the growth will always be there. Never focus only on market share. Market share is important, but most important is to make sure that you set for yourselves clear goals, goals on growth, goals on asset quality, and make sure that these goals are always met. It's not difficult. It's been done for so many years, decades and decades. It can continue being done for several more decades. And I believe once the merger happens, the growth potential can only increase because of the ability to cross-sell. Last year, for example, on the retail book, on the individual book, HDFC grew our individual home loan book by 17% on a large base. This is with less than 30% of our business being sourced by HDFC Bank. Now, going forward, the amount of business that can be sourced or that would be sourced through the HDFC Bank network can be huge, which therefore means that the growth potential once the merger settles, let's say 3 months, 4 months into the merger, the growth potential can be enormous.
And it is the mother of all mergers in India's corporate history. HDFC and HDFC Bank merger will be effective from July 1st. We spoke to Bandhan AMC's Manish Gunwani and Sudeep Bandyopadhyay about the mega merger.
As a bank shareholder, I think, if you have a long-term view, I think it's a fantastic thing. There will be short-term challenges on the, SLRs, CRRs and things like that. And there are some challenges on, divesting of certain assets in a certain specified time as warranted by the regulator. But these are very short-term issues. I think if you look at a 6 to 12 months time horizon, it's a great thing which is happening to HDFC Bank and for HDFC Bank shareholders. Also from a HDFC Limited shareholder point of view, this is probably the best option for them, and that's what is happening. So I don't think there is any cause for complaint. Little bit of turbulence, little bit of volatility, which we have seen since the the merger was announced. I guess it was par for the course.
It's quite interesting that the giant of the sector on the private side, they are having a fairly aggressive phase of branch opening and restructuring of the liabilities. And I won't say restructuring, just that since they've absorbed the NBFC, they want to kind of increase the retail liabilities in a very aggressive manner. I think they seem to have a right to win in that sense that given the brand and given the existing economies of scale, given the technology which is on an aggregate better than PSU banks, the culture and the HR and all that. So I think it's exciting that the Indian market is producing a market cap of that scale. Clearly, given that size, the erstwhile growth rates which were there for last 10-15 years may not be there for the next 10-15 years. So to that extent, I guess the returns will have to be seen in that context. But otherwise, I think it's a exciting and a kind of milestone for the Indian stock market that a market cap of that magnitude is being created.
That's all we have for you in this segment. Thank you for watching.